So we know that this current bear market that we're in is a very unique bear market because there's no recession, although the first 2 quarters was negative GDP. There's a technical recession, but it's not an official recession. And then in quarter 3, we've got GDP growing at 2.6% and fourth quarter GDP estimated at over 4%. So again, this bear market not caused by any official recession and not caused by any earnings contraction. If you look at the corporate earnings of the S&P 500, yes, earnings have been slowing down, but earnings are still growing. So remember that this bear market is caused entirely by the Federal Reserve raising interest rates, the Fed funds rates, too fast. That caused the 10-year yield to go up too fast, and that's the only thing that's causing this bear market. So again, like I said many times before, this bear market is so-called being engineered by the Fed to pull down asset prices to control inflation. Now, the good news is that the catalyst that's been driving the market down may be coming to an end, because last Wednesday, the Fed, during their minutes, they said that, hey, we're going to start slowing down our rate hike increases. So I said before that the reason the market tanked is not because they increased interest rates, but because they raised rates too fast. And the moment the Fed starts to slow down their rate hike increase, now they will still raise rates, they don't have to cut rates, they don't have to stop raising rates. As long as they stop raising too fast, the market will rally. And that's what they seem to be doing right now. Because again, last Wednesday, they're saying that, hey, we're seeing the need to start to raise rates less aggressively. So one reason is they're beginning to see signs, leading indicators that the economy is beginning to really slow down. They're beginning to see signs that inflation has probably peaked, and the leading indicators of inflation are coming down. Like if you take a look at the 5-year break-even inflation rate, it has really been rolling over. So expectations of future inflation have really come down. And you can see that as they start to talk this way, the 10-year Treasury yield has been rolling over as well. So again, if you take a look at the charts, you can see when the 10-year yield goes up aggressively, the market goes down. Now that the 10-year yield is going down, the market has been rebounding. So that's the great news. It looks like what's causing this bear market is gonna be over. But here's the bad news. The bad news is that if all their rate hikes this year leads to a recession next year in 2023, then that could cause a new catalyst to trigger the market to go down again, which is bear market part 2. Because if that leads to earnings contraction, the market could very well go down again next year. So what I'm saying is that for this year, it looks like this is the market bottom for this year. And it's unlikely to go lower because the Fed is now beginning to raise rates less aggressively. So that reason, it's over. But again, if we get a recession next year with earnings contraction, then there'll be a new catalyst that would lead the market lower. So the question is, how low can the market go if we get a recession and if we get earnings contraction? And the question is, how do we protect ourselves from it and how do we profit from it more importantly? So let's find out more in this video. So what is the probability of a US recession in 2023? Well, among all the top economists in all the investment banks, they can't agree. So you can see that out of 60 forecasts by economists, they all have different opinions. You've got some economists from Bank of America saying it's 100% probability of a recession next year. And you've got some other economists from another bank saying that no, it's only 20% chance of a recession next year. You got Goldman Sachs that prepared this chart, and Goldman Sachs has a 35% chance of a recession next year. So out of all these economists, if you take the average consensus, it's about a 65% chance of a recession next year. The reason it's so hard to predict a recession is because some indicators tell us that we're going into a recession, but other indicators tell us that there's no recession. For example, there are 2 indicators that tell us that there's going to be a recession. The first would be the leading economic indicators, which is what you see in blue over here. So you can see that this shaded area represents past recessions. And every time the leading indicator in blue, it goes below 0, a recession would follow. So for example, you can see over here, the leading economic indicator went way below zero. What happened? Recession. When way below zero, recession. Happened almost every single time. And as of October, you can see the leading economic indicator went below zero. It is now at minus 2.7%. So this is one indicator that is telling us that there will be a recession probably next year. And you can see that every time this happens, corporate earnings would decline, which causes the stock market to go back down lower. So again, you can see over here, the red line represents corporate earnings, forward corporate earnings, and the blue line will be the leading indicator. And you can see when the leading indicator goes down in blue, corporate earnings go down. Happen every single time. And once again, what happened, you can see that the leading indicator has dropped below zero to minus 0.27%. Corporate earnings have not contracted yet, but based on this leading indicator, they may start contracting next year. So that's one signal that we're going to have a recession next year. We're going to have corporate earnings contracting. Another clear signal of a recession, you've heard, I'm sure, is the yield curve, the inversion of the yield curve. Now, historically, I've looked at the 2-year versus the 10-year yield curve. But what I found through a lot of research is that the 3-month and 10-year yield curve is a lot more accurate prediction of a recession. Now, again, if you take a look historically, notice the gray areas are recessions. Now, every time the 3-month and 10-year treasury yield spread, once it goes below zero, can you see zero over here? Right? Once it goes below zero and goes above zero, recession. Goes below zero, goes above zero, recession. Goes below zero, goes above zero, recession. Recession is the graded area, right? Goes below zero, goes above zero, recession. So what's happening right now? Right now, the spread on the 3-month, 10-year yield curve has gone below zero, but it's not gone above zero yet, right? So once it goes above zero, a recession. So far there are 2 indicators telling us that recession may be happening next year, but then again there are other indicators that's telling us that, dude, where's my recession? Okay. For example, if you take a look at the GDP Now estimates by the Atlanta Fed, which tracks GDP in real time based on all these coincident economic indicators, there's no sign of a recession, right? In fact, in quarter 3, GDP came in at 2.6% growth. And right now, the projection for quarter 4 is 4.3% GDP growth, right? So the current coincident indicators are still very strong. They are still showing growth. And of course, based on the last quarter corporate earnings, they are still above zero. They are not contracting, although they are growing more slowly. What other indicators can we look at? Now, remember that 70% of US GDP comes from consumer spending. As long as consumers keep spending money, GDP will not contract and there will not be a recession. So the question is, will consumers continue to spend next year, or will they hold back their spending? The good news is that real disposable income is actually going up. Now, what is real disposable income? It is the income that Americans earn minus inflation. So for example, if they earn $3,000 a month, for example, okay, or rather, if their income rises 5%, but inflation rises 7%, that's called real income declining because their income can't keep up with inflation. But now that inflation is going down, what happens? Even though their income goes up 5%, but now inflation goes up less than 5%, their actual real income increases. So the good news is now that inflation is beginning to moderate, real income is actually rebounding. So you take a look at this chart, you can see this red dot over here. That's real disposable income. And as of projected, you can see that it is still below zero. real disposable income is still below zero, but it is rebounding. Can you see it's rebounding? And it's projected by Goldman Sachs research that by March of next year, it will actually turn positive, which is a good sign that, hey, real income is increasing, consumers have more income, they'll spend more, and there'll be a lot more economic growth next year. So again, this indicator contradicts the other indicators. That's why it's so hard to predict a recession, because there's so many conflicting indicators. Now, if you look at all past recessions, they happened because the labor market was very weak, because there was high unemployment. People couldn't get jobs, they couldn't earn money to spend. But right now, the unemployment rate is still at historical lows, just above 3.7% unemployment rate. Now, could the unemployment rate go up dramatically to 5-6% in past recessions? It's going to be a bit difficult. Why? Because right now, there's still a very wide jobs to workers gap. What does it mean? That means right now there are more available jobs than there are workers. In fact, there are 4 million more available jobs than there are workers. Right? Now, it used to be 6 million. It's gone down to 4 million. Now, ideally, the Fed wants it to drop to about 2 million. So 2 million means that there are still 2 million more jobs than people looking for jobs, which is still very, very accommodative, a very, very good, strong labor market, right? But right now, it's still at 4 million. So in other words, there's a lot of available jobs. People will not find a job, okay? And job openings are way above labor supply. If you take a look at this chart over here, you can see that the white line are job openings, and job openings are still way above labor supply, which are people looking for jobs. Now, historically, you can see in past recessions and bear markets, there were less job openings than people looking for jobs. But now it's the opposite. Now, some of you may say, but Adam, recently I've been reading a lot about the tech layoffs that, Twitter cut 50% of their workforce, Meta, Amazon, they're all, firing thousands of workers. Isn't that a bellwether that other companies are going to retrench their workers, and is that going to cause higher unemployment? Well, not really. The reason is because the tech companies represent only 2% of all employment in the country. Okay? And the tech layoffs so far are barely more than 0.1% of total US payrolls. So in other words, it is very insignificant. Okay? So again, all the tech workers only represent 2% of American workers, whereas the leisure and hospitality industry represents 11% of American workers. And in that industry, they are struggling to hire workers. Okay? So the reason is because the tech companies overhired during the pandemic. They overhired, and so they now need to retrench to get back to normalization. But the rest of the country, they are still hiring like crazy. So in other words, the labor market remains strong. As long as the labor market remains strong and real disposable income goes up, US consumers should be able to continue spending, and GDP should continue growing next year. So in conclusion, in my opinion, will there be a recession next year? It's really 50-50. So what's important is to always expect the best, no recession, but prepare for the worst. That, okay, if there is a recession, if there is going to be earnings contraction, if the market is going down again, how do I make money from it? Or how low can the market go? Now, based on my calculations, I assume a 10% contraction in corporate earnings multiplied by the trough PE multiple during the COVID pandemic. That gives me a target on the S&P 500, if there's a recession, to go down to 3,257 points. So roughly, that would be about, if I use my measuring tool here, that will be roughly going down about 19% below current levels. And again, that's the recession scenario. Now, if there's no recession, then the market will keep going up because of inflation coming down, earnings growth resuming, and then the market could then go to my first target for next year, if there's no recession, is the market is going to go to 4,005. There's a 12% gain from current levels, and if the market hits the second target based on the earnings estimate of most analysts without a recession, that will be a 22% gain from current levels to 4938. All right, so we're going to see what happens because, we can't predict the future. But let's come to the next question. Okay, so if we do get the next leg down, again, we're looking at the price action. When you make trading decisions, now, let me just separate. For investments, like I've always said, if you're holding great companies, in my investment portfolio, I don't intend to let's sell and buy it back. No, I'm just going to keep it because, all these uptrends and downtrends, they are short term. Over time, great companies will always go up. So I just want to keep my great companies. Now, if you invest in companies that are great, there are only two reasons you should sell if you expect another leg down. The first reason you should sell is that if you're over leveraged, like if you have bought a lot of stocks or borrowed money, if I were you, I would bloody sell those stocks and reduce my leverage in case we get another crash next year. Or if you're holding companies that you realize are not very good companies, they are not very profitable, then I would sell them and reallocate them to really great companies. The other thing to also understand is that in your investment portfolio, you've got to be well diversified. So for example, in my portfolio, I don't just have tech stocks. I've got financial stocks, I've got healthcare stocks, I've got consumer staple stocks, I've got consumer discretionary stocks. So when you diversify across different sectors, different industries, even if there's a recession, it will not hit all the industries equally. So there are certain industries that will actually benefit from a recession. The more defensive sectors like healthcare, consumer staples, those can continue to go up, in fact, or go down less in a recession. So you got to follow all these rules that we actually teach in our investing course to diversify, to allocate properly, and to only buy very good companies. Now, from a trading perspective, right? So whether you've taken my stock trading course or you've taken the options classes that we have, you learn that it doesn't matter. Market can bloody go down. We can make money from markets. How? By shorting the market. So obviously, if I see the price action beginning to turn down, I'm going to short the market again. There are many ways to short the market. One way is to buy the inverse ETFs, like the SH, which is the short S&P ETF, or the DOG, which is the short Dow ETF. Or you could simply short the underlying stock, the SPY or the DIA. Now, but again, the problem with shorting directly is that it can be quite risky because if you short the market and the market suddenly goes up, right? Suddenly it's like, it thinks it looks like it's going down, and then it's a bear trap, boom, goes up. The shorts get their faces ripped off. So a lot of people can get killed on the short side. So when I short the market, I want to make sure when I short the market, there's limited risk. So if the market goes up suddenly, I don't lose that much. But if the market collapses, then I can make a lot of money. And the only way to do that is through options, using bear put option spreads, where you buy puts at the current level right now or slightly out of the money, and then you sell puts at a lower level. So with a bear put option spread, you kind of like hedge and protect your risk. Okay, so that's one way to do it. Buying put option spreads on the S&P 500 or SPY or DIA or even Triple Q. Another thing that you could do that we actually teach in our courses is to go long on the VIX, the volatility index. So again, if you look at the VIX, which is the volatility index, most of the time you can see it goes opposite of the S&P 500. Let me just go on to daily candles so you can take a closer look over here. So you can see when the market goes down, what happens? The VIX goes up, right? Because market goes down, people are fearful, the VIX goes up. The VIX is known as the fear indicator. When the market goes up, people are complacent, no problem, the VIX goes down. So the VIX goes opposite of the S&P 500, right? So now that the S&P is going up, the VIX is going down. But notice that the VIX is going down to a potential support level. So if the market can't break that resistance, or it breaks it and it's a bull trap, it goes down because of a recession, what's going to happen to the VIX? Hallelujah, the VIX is going to explode upwards. So one of my strategies is I could potentially look at buying call options on the VIX. on the VIX futures. So again, I've made videos on this in the past. If you go on YouTube, you can search my past videos where I show you how I actually buy call options or call option spreads on the VIX futures. And of course, we teach all this in our options trading course as well. So that's another way to make money if the market crashes next year. Another way to make money is a lot simpler. Okay, now here's the thing. If we get a recession next year, guess what the Fed is probably going to do? Right? If we get a recession next year, the Fed will definitely, well, not definitely, but high chance the Fed will start cutting interest rates. Now, when the Fed cuts interest rates, guess what's going to happen? A few things are going to happen. All right, let me write this down for you. When the Fed, well, if the Fed cuts interest rates because there's a recession, number one thing that's going to happen is that the 10-year yield is going to continue dropping dramatically. The US dollar will fall, bond prices will fly, and gold will likely fly up as well. So one way to profit from this is to buy bonds, okay? So disclaimer, I've already started buying, right? So specifically buying bond ETFs. So I've actually been buying the TLT bond ETF, which I alerted my students a couple of days ago. You can see over here. This is our Discord chat group. By the way, I'm out of Telegram because Telegram, too much piracy and scam. So now my entire community is on the Discord channel. So you can see that, yep, on the 22nd of November, I sent an alert and I told my private community that, hey, I am starting to buy the TLT bond ETF because right now as the 10-year yield is coming down, the TLT is going up. And if there's a recession next year and the Fed cuts interest rates, then the TLT will fly to heaven. All right, so buying the TLT or long the TLT, in my opinion, is kind of like a hedge against inflation. So I've already done that. So, and I actually use options to replicate my TLT long exposure. I may make a video on it in the future, but you will learn it on the options course. I'm using a bullish synthetic spread to go long on a TLT because by doing that, I use very little capital to buy a huge position in TLT, because if you just buy the shares itself, it's going to cost quite a bit of money, right? So you can see historically what happened when the Fed cut interest rates. So again, this yellow line represents the Fed funds rate. And when they started to cut interest rates, what happened? Again, this is the gold ETF, GLD. Gold started rallying very strongly. TLT bond ETF rallied very, very strongly, right? So you can see that when the stock market went down, gold went up and bonds went up. So that kind of like hedges your investment stock portfolio, right? Same thing over here. You can see when the Fed cuts interest rates over here, what happens? Gold goes up, bonds go up while the market crashes. So by going long on gold and going long on bonds using the ETFs, that will hedge the stock decline in your investment portfolio if you're holding stocks. But again, these stocks would then rebound later on. In the meantime, you can take your profits from gold and TLT. A reminder that all my courses and playbooks are going for up to 75% off for a very limited period of time. So go on to piranhaprofits.com and grab your favorite courses, whether it's the stock trading course, the value momentum investing course, the option courses, or the price action manipulation courses that's going to give you the skills and knowledge to succeed in today's markets, and join our private community of traders and investors.